It's Friday afternoon. Payroll runs tonight. You know the number. You've known it all week. And you've also known since Tuesday when the deadline passed that a draw that you were counting on still hasn't landed. You've called them twice, left a voicemail, sent a follow up email that felt professional but read, even to you, like desperation wearing a professional outfit. The client hasn't responded. The crew doesn't know that any of this is happening. They'll show up on Monday expecting the job to keep moving, and you're sitting at your desk on Friday afternoon doing math that you've already done 3 times, trying to find a version of the numbers that make this week feel okay. Welcome back to Brickonomics, the business of building. I'm your host, Nick Scroggs, and if you've been in this business for more than a year, you probably have felt this feeling. And if you're like most builders, you've filed it under client problems. Difficult clients, slow payers, people who don't respect the terms that they agreed to. Some of that is true. Some clients are genuinely difficult. Some clients do make choices that put you in this position, but I want to offer you a different explanation for why this keeps happening. One that's harder to hear, but potentially more useful. The billing system most builders use by default creates conditions for this moment so reliably that it might as well be designed to produce it. The milestone billing structure, the sporadic invoice schedule, the delivery conversation that leaves questions unanswered, all of it builds towards Friday afternoons, just like this one. The problem isn't the client, it's the system, and the system can be fixed. Milestone billing feels intuitive. You reach a visible stage of completion. The framing is done, rough ends are complete, drywall is finished, and so you invoice. The client can see the progress, and the payment feels justified by something tangible. The problem is that your costs don't happen at milestones. They happen every single day. Payroll is every 2 weeks, whether framing is complete or not. Materials arrive continuously and need to be paid on terms that don't wait for your next milestone. Subcontractors bill when their work is done, not when it's convenient for your draw schedule. The money going out of your business is continuous and relentless. The money coming in under milestone billing is sporadic and unpredictable. That gap between continuous outgoing cash and sporadic incoming cash is where builders quietly finance their clients' projects without realizing it. Here's how that timeline actually plays out on a milestone build job. You spend 2 to 4 weeks putting money out the door. Labor, materials, subcontractors. You reach the next milestone, so you create the invoice. The client reviews it, they move money, the bank processes the draw, and somewhere in that sequence, you've been floating 30 to 60 days of expenditure before cash actually hits your account. Meanwhile, payroll was last Friday and the Friday before that. There's a second problem with milestone billing that's less obvious but just as damaging. It makes cash flow projection nearly impossible. When invoices land at random intervals depending on when jobs reach their next stage, you can't build a consistent collection process around them. Some months, 3 milestones land at once and the account looks healthy, while other months, nothing lands for 3 weeks and the pressure builds. You can't plan around a billing schedule that you can't predict. There's also a subtler problem with milestone timing. Milestones can be gamed, consciously or not. When cash gets tight and a milestone is close, there's a temptation to call it reached slightly earlier than it actually is. That distorts the schedule, creates client distrust, and compounds exactly the problem that you were trying to solve. The result of all of this is that most milestone billing builders spend a meaningful portion of their time chasing money. Not because their clients are bad, but because the system was built to be chased. When we moved from fixed price to cost plus after COVID, we also changed our billing structure to monthly. All invoices going out at the same time every month and on a predictable schedule. The immediate benefit was predictability. We knew exactly when invoices were going out, exactly when they were due, and exactly when follow-up needed to happen. For the first time, we could build a real collections process because the collections process finally had a rhythm that it could be built around. The secondary benefit was cash flow clarity. When every invoice goes out on the 1st of the month and is due on the 10th, you can plan outgoing cash against incoming cash with actual accuracy. The projections we talked about in episode 5, weekly cash flow reviews, upcoming obligations, pressure points. Those became meaningfully more reliable the moment the billing became more predictable. But I want to be honest about the resistance because glossing over it would be doing you a disservice. 35 invoices going out on the same day is not the same as 5. The effort concentration is real and it's significant. When we were milestone billing with a smaller portfolio, a project manager could put together an invoice relatively quickly because the milestone was a defined moment. Monthly billing requires perpetual input. Every receipt cost coded correctly, every labor hour attributed accurately, every line item ready to be explained all month long, not just at the end. The project managers who struggled most with this transition were the ones who waited until the last week of the month to reconcile everything. Getting caught up on 35 jobs simultaneously is genuinely terrible. It produces errors, it produces fatigue, and it produces the exact kind of invoice inaccuracies that create client distrust at the worst possible moment when you're trying to collect payment. The project managers who adapted well understood that monthly billing changed the way that their jobs actually ran. Financial tracking stopped being something you did before you invoiced. It became something you did all month so that invoicing was a release, not a scramble. There's also a client relationship dimension to monthly billing that most builders underestimate. Clients ask surprisingly consistent questions under milestone billing. When is the next payment due? How much will it be? Should I move money now? When do I need to talk to my bank? Milestone billing creates perpetual uncertainty for the client about what's coming up and when. Monthly billing eliminates that uncertainty. Every month, an invoice arrives. The client knows when to expect it. They know how to plan around it. They can coordinate with their lender on a predictable schedule. And this is how virtually every other professional service relationship works. Lawyers, accountants, architects all bill monthly. The client who finds monthly billing unusual has simply never thought about how inconsistent milestone billing is with every other professional service in their life. Monthly billing at scale only works if the people delivering those invoices know exactly what's in them and why. This is not a small thing. It's actually probably the single most important operational requirement of the entire system. The moment a project manager seems uncertain about a line item, hesitates on a question, says they'll have to check and call back, or can't explain in plain language why something was billed the way that it was, the client takes that as a permission to delay. Not because they're trying to be difficult, because uncertainty in the invoice conversation signals that an invoice might not be right. And if the invoice might not be right, waiting to see if it gets corrected before paying is a completely rational response. This isn't a client behavior problem, it's a preparation problem. You wouldn't send a salesperson into a pricing conversation underprepared. You wouldn't send a project manager into a scope meeting without first reviewing drawings. Don't send anyone into an invoice conversation without thoroughly reviewing the invoice first. I want to tell you about a situation we had that illustrates exactly how quickly this can go wrong. We had a client on a cost plus project. At one point, some dumpster fees were accidentally coded to their job. Fees that genuinely belonged to a different project. The client found them, pointed them out, and we went into the invoice and removed them. It was clear, once we looked, that all of the bills were for the wrong job. The other job's name was right there on the attached receipts. We corrected it, explained what had happened, and then we moved on. The next month, the same dumpster fees appeared on the invoice again. Same error, same line item, still clearly labeled with the other job name on the attached bills. We hadn't reviewed the invoice carefully enough before it went out. This time, the client's response was different. 2 identical errors in a row on the same line item, regardless of how clearly the bills showed the correct job name, led them to conclude that we were intentionally trying to overcharge them. There was nothing I could say to change their mind. The evidence from their perspective was the pattern, and no amount of explanation about cost coding errors and administrative mistakes landed the way that I needed it to land. That situation took weeks to try to recover from, and ultimately, we didn't. We actually never finished that job. Those errors started a spiral we couldn't pull out of. The trust that had been damaged by 2 small mistakes, probably $500 in total cost between the 2 incidents, was never fully repaired. The client's posture towards us changed permanently. Every subsequent conversation happened in the shadow of those two invoices, and eventually the relationship deteriorated past the point of no return. We lost a $300,000 project over it. I want to be clear about something. That client was extreme. We didn't know how extreme until that happened. Most clients who encounter an invoice error, even a repeated one, will accept a clear explanation and move forward. But this situation had revealed something about the client that was already there. The errors didn't create the problem, they gave an already difficult client a reason to act on something that was always in them. But here's what I've thought about many times since then. If we had reviewed that second invoice carefully before it went out, if we had caught those dumpster fees before they hit the client, we may have never handed them that reason. Whatever was already in that client would have no trigger. The relationship might have survived and the project might have finished. $500 in errors, $300,000 in consequences. Now, this is not a normal outcome, but it is a real one, and it's the clearest illustration I have of why invoice accuracy is not an administrative obligation, it's a risk management strategy. Here's the lesson underneath that story. Contractors already have a bad reputation. As an industry, we've earned a level of distrust with the general public that we carry into every client relationship before we've done anything wrong. Most clients who hire a contractor are starting from a place of mild suspicion, not necessarily of you specifically, but of the industry broadly. They've heard stories, they've had bad experiences, they've watched enough renovation television to have a set of preconceived notions about how things usually go. Every invoice error confirms what they were already worried about. Every accurate, clearly explained, promptly delivered invoice pushes back against it. Invoice accuracy is not just a financial obligation, it's a trust building strategy. You're not just getting the numbers right, you're actively working against the industry-wide reputation problem every single time you send out an invoice. The standard we hold ourselves to: every question the client has should be answerable on the first call. Not after you've had time to review it, not after you've called the subcontractor back to check, on the first call, in plain language, confidently. If you can't meet that standard for a line item, that line item should not be in your invoice until you can. Even with a clean invoice and a confident delivery, disputes still happen. A client questions a line item. A subcontractor charge looks higher than what they expected. A material cost doesn't match what they remember approving. These situations are a guaranteed feature of any cost plus project, and they require a specific protocol that most builders have never been taught. The instinct when a client raises a dispute is to put the entire invoice on hold until the dispute is resolved. That instinct is expensive. A $400 question should not hold up a $28,000 invoice for 3 weeks while you chase resolution, but that's exactly what happens when you hang up the phone with an open dispute and no defined process for what comes next. Here's the rule: never hang up from an invoice conversation with an unresolved dispute. Not because you have to resolve every dispute immediately, some disputes take time and investigation, but because the moment you end that call without a clear next step, you've given the client an indefinite deadline. The invoice isn't due until the dispute is satisfied, and that dispute can take as long as they need it to take. The protocol is straightforward. If a client raises a disputed item during an invoice conversation, address it directly on the call. If you can resolve it, if you can explain the charge clearly and they can accept the explanation, great. The invoice stands and the payment deadline holds. If you can't resolve it on the call, if it requires investigation, a conversation with a subcontractor, or time to pull documentation, you remove the disputed portion from the current invoice before you hang up. Then you say something like this: I've removed the disputed items from this invoice. Since there's nothing remaining in dispute, I need the balance paid before the original deadline. We'll address the disputed portion separately once we've had a chance to review it. What that does is it separates two problems that don't have to move at the same speed. The dispute is a conversation. It takes time. You investigate, you gather documentation, and then you come back with a clear answer. The undisputed balance is a contractual obligation with a deadline. It doesn't have to wait for the other dispute. This changes the entire dynamic of the conversation. The client can't use a small question as leverage to delay the entire payment. The dispute gets treated as a legitimate concern, taken seriously, removed from the current invoice, investigated properly, and the undisputed balance gets treated as what it is: money owed for work delivered. You're not financing tens of thousands of dollars while chasing resolution on hundreds. You're collecting what's undisputed now and handling the rest in parallel. That's a completely different cash position. One important note: this protocol requires that the invoice conversation happens before the deadline, not after. If you send an invoice and wait for the client to call you with questions, you've lost the ability to execute this protocol in time. The invoice conversation should happen when the invoice goes out, not when the payment is already late. Even with monthly billing, clean invoices, confident delivery, and the disputed balance protocol, there will be moments when payment doesn't arrive. The review window has closed, disputes have been addressed, the undisputed balance is clear, and the payment still hasn't come. At that point, there's only one reason that the money isn't in your account: your client has made a choice. And when a client has made the choice to not pay for work that you've already delivered, work that they have no legitimate dispute about, continuing to do more work is financing their project. You're essentially extending credit to someone who has demonstrated that they won't honor the terms that they agreed to. You are not a bank. This is when the job stops. Not as a threat, not as an emotional response, but as a procedural consequence that's already defined in the contract that both parties signed. The most common trigger for a job stop isn't outright refusal to pay. It's a client who has decided that they shouldn't be charged for something that is legitimately billable to their job. Particularly on cost plus work, this happens when a client gets comfortable enough with the transparency to start editorializing about what they think they should and shouldn't pay for. Even when the item is clearly legitimate, clearly documented, clearly tied to their project, clearly within the scope of cost plus, means they've decided that they're not paying for it. When that conversation has been had and the dispute is genuinely not resolvable, when the client simply won't accept a legitimate charge, the job stop is often the most professional thing that you can do, both for yourself and for them. For yourself, because you stop accumulating unreimbursed expenditure on a job where payment is already in question. For them, because a job stop is a clear, concrete signal that the situation is serious. It's harder to ignore than a phone call. It creates urgency in a way that a strongly worded email cannot. We've had to execute job stops, and the first time is uncomfortable in a way that's hard to fully prepare you for. You're stopping somebody's project. You're disrupting their life and their schedule. You're having a conversation that nobody wants to have, and you're doing it while a part of your brain is telling you that maybe you should just wait a few more days and give them the benefit of the doubt. But here's what I've learned about this discomfort: that a discomfort is the price of the system working. If you execute the job stop the first time it's warranted, cleanly and professionally without anger, one of two things happens. The client pays, the job restarts, and the relationship continues with a new and clearer understanding of how payment works. The client will not test that system again. Or the client's response reveals what was always going to be a problem. They escalate rather than resolve. They dispute the stop rather than addressing the payment. They show you in their reaction who they are as a client. And at that point, you haven't just protected your cash flow, you've received important information about whether this relationship is worth continuing. A collections process that never gets enforced is not a collections process, it's a suggestion. The job stop is what gives everything else credibility. Without it, the invoice deadline is a preference. The review window is a courtesy. The disputed balance protocol is a favor. With it, every part of the system has weight because the client knows, having seen it written in the contract and having heard it explained at the project kickoff, that the consequence is real. Here's what I want you to take away from this episode. The builders who get paid late are not, for the most part, getting paid late because they have bad clients. They're getting paid late because they have a billing system that makes late payment structurally easy. Unpredictable invoices that clients can't plan around. Delivery conversations where uncertainty signals that the invoice might not be right. No defined protocol for disputed items that keeps the undisputed balance moving. And no enforced consequence for non-payment that gives the whole system its teeth. Monthly billing, invoice confidence, the disputed balance protocol, and the job stop are not four separate tactics. They're all part of one system. Each piece depends on the other. Monthly billing creates the predictability that makes a collections process possible. Invoice confidence is what makes the billing conversation a transaction rather than a negotiation. The disputed balance protocol is what keeps a small question from holding a large payment hostage, and the job stop is what makes all of it mean something. None of this is about being difficult or adversarial with clients. It's about being clear. Clear billing, clear conversations, and clear consequences. The irony is that clients almost universally prefer this to the alternative. They prefer knowing when to expect an invoice. They prefer a project manager who can answer their questions on the first call. They prefer a process that's predictable enough that they can coordinate with their lender, their financial planner, or their own cash flow without surprises. The billing system that protects your cash flow is also the billing system that creates the most professional client experience. Those things are not in tension, they're actually the same thing. Construction projects don't run on profit, they run on cash. And if your billing system doesn't match the way that work actually happens, if money is flowing out every day while invoices land wherever a milestone happens to arrive, you'll spend your entire career building houses while financing them for your clients. In the next episode, we're going to stay inside contracts and risk and talk about change orders, where most profit is actually lost. You now have a billing system that protects your cash flow. The next question is how to protect the margin that was priced into the contract in the first place. Because in construction, the original price is just the starting point. What happens to the price over the course of the project is what determines whether the project was actually profitable. Thanks for listening to Brickonomics, and I'll see you in the next one.